Good afternoon, and thank you for joining us today. Hope you all had a great Thanksgiving weekend and are easing back into the work week. Today's presentation is on your end-of-year sales tax checklist. Your presenter today is our CRO and partner, Brian Greer. Just a few housekeeping items before we get started. All your lines are on mute and will remain on mute throughout the webinar. Just as a reminder, this webinar is not eligible for CPE credit. We will be providing a copy of the slides, which can be found in the handout section of the GoToWebinar panel, and a recording will be emailed out later this week. If you have any questions, please submit them within the questions box on the GoToWebinar panel. We'll do our best to get to all the questions, but if there's anything that should be answered in private or we can't get to them all, we'll respond to those afterwards via email. Thanks again for joining us, and with that, I'll pass it over to Brian.
Hey, thanks, Kate. Appreciate the intro there, and welcome everybody this afternoon. Glad you were able to join us today. I will provide you kind of a quick overview of Tax Connects and our business before I get started here. I think some of you have probably attended some of our webinars in the past, so bear with me if this is a little bit of repeat for you. But Tax Connects, I think of us, primarily as a tech-enabled financial services company. So that's a lot of words. What does that really mean? Essentially, what we do is we focus in the sales and use tax industry, and we provide really two different types of services. One is a consulting or advisory type of service, where a lot of times we help companies understand where they have nexus, where they have taxable sales. We get into some voluntary disclosures as well. It tends to be more project-oriented type of work. And then we also have a compliance outsourcing service where, for a lot of our clients that have a multi-state sales tax obligation where they have to collect and remit the sales tax, we essentially step in as an outsourced sales tax department and manage that for them. So with that as our background, let's kind of take a quick look at the agenda here. And, as I was getting ready to talk with everyone here this afternoon, it kind of dawned on me, and it actually dawned on me maybe a week ago. The year's almost over, right? It's December on Friday, and it's a time to really kind of look back on the year. What did we achieve? What did we maybe not achieve or not do that we had intended on doing during the year, and kind of set some plans and strategies for the following year as well. So that's kind of the genesis of this conversation here this afternoon, is specific to sales tax. What if we take a little bit of a step back, look at our business, make sure we're in good shape. If we do have potential gaps or some type of sales tax risk or exposure, we've got the opportunity now to fix that moving forward. So that's kind of what the thought process is here in terms of the different types of topics that you see listed here. So let's just go ahead and look at the first one. And this became, in terms of remote employees, very prevalent, of course, in the post pandemic era that we're living in, where there's a lot of capabilities for working from home, working remote. I know for us, Kate and I are both working from our home offices today. It opens up an opportunity for businesses to hire really good talent and really good resources and not be restricted, to their home state or their home city. So just from a Tax Connects perspective, we're based here in the Atlanta, Georgia area, and probably for the first 10, 12 years of our business, just about everybody, if not everybody, was based in Georgia. If you look at our business now, I think we have employees in 7 or 8 different states. So it's a time to really look at your employee base. Has it changed? Have you added remote employees? And the reason that's important, maybe the answer is obvious, but the reason that's important is having employees in any particular state is typically a nexus creating activity for businesses, meaning having that physical presence in the state equals or leads to sales tax nexus, and then the potential to have to follow that state's sales tax rules. Again, thinking about it and looking at it from a Tax Connect's perspective, fortunately for us, and I'm getting a little bit ahead of myself here, but fortunately for us, we provide in most states a non-taxable service. So even though we have employees in a number of different states, it doesn't necessarily mean we have a sales tax obligation, but it should be kind of a trigger for you if you have added employees in other states to at least think about that, maybe ask the next question, okay, we've got employees, do we have revenue in the state? Do we have taxable sales in the state? You know, what is the potential risk or exposure here to the business? Another factor, and this may not necessarily be something that changed during the year, it could have changed, but perhaps the business model has always been a scenario where you leverage subcontractors to some extent. And maybe in leveraging those subcontractors, perhaps didn't know or realize that that has a tendency also to create a physical presence for your business. A lot of conversations I have with companies, they'll have kind of the general perspective or the general comment that, you know, I don't have any employees in the state. I utilize subcontractors to do any installation work. I'm good to go. I don't have anything to worry about from a sales tax perspective. Well, however, you do need to take a look at that, and you need to understand what those subcontractors are doing on your behalf and how they're being engaged and operating with your clients. If we look at an example of someone that's selling tangible personal property and then having it installed, just as a simple example, I can look out my window and I can see, you know, some type of swing set in my backyard. It's a tangible piece of property. When we bought that, we also paid for someone to come out and set it up and install it for us. Now, if your customers are purchasing that TPP, that tangible personal property from you, and they're also purchasing from you the installation services, you may choose to utilize a local contractor to satisfy or to perform those installation services on your behalf. In that case, the end consumer, the client, has contracted with your business for the installation. You're leveraging and utilizing a local resource to deliver that service to your customer. And that leveraging of that local resource, excuse me, is another physical presence nexus creating activity that you need to be aware of. In addition, and this one also sometimes catches people a little bit off guard, maybe applies more to manufacturing organizations that don't necessarily have their own sales force. I say that because a lot of manufacturing companies, there are manufacturers reps that may represent a lot of different products. Those manufacturers reps are often 1099 contractors or, you know, commissioned salespeople. They're helping establish and grow a market for you. So again, even though they're not employees, they're likely creating a physical presence and likely creating sales tax nexus for you. So just again, something to be aware of. Again, it may not have changed in your business, but if that was something that you didn't realize previously, it's definitely something to look at. Similar to the first example, doesn't mean that you have a sales tax obligation. It probably does, certainly if you're selling TPP and utilizing that local contractor to install it for you. But it just means, hey, we better look at the sales tax rules in the state and understand if we do have some type of obligation or not. So this next one, and you see it labeled as, did your e-commerce sales increase during the year? And it's not just an e-commerce scenario that we're talking about here. It's really any sales activity. You know, was there an increase or new states where you started selling into during 2023. And the reason that's important, I think most of you are probably aware and have heard of Wayfair, the U.S. Supreme Court case back in, what was it, June of 2018, that established economic nexus as a means for creating sales tax nexus, or a means by which states are able to hold you accountable to their sales tax rules. You see that really every state today that has a sales tax at the state level, they have economic nexus standards in place. Most of these, there is variation from state to state, and the variation comes in a few forms. It could be the revenue amount can vary from state to state. There could be a number of transactions or a number of invoices that vary from state to state as well. And also, two other factors is whether the state considers gross sales or taxable sales in their economic nexus standard, and whether they look at current calendar year, prior calendar year, previous 12 months. All of those factors have some level of variation from state to state. So it can get kind of confusing, but for simplicity, I usually think about it, if I've got $100,000 of revenue in any state, I should ask the question, okay, I probably have Nexus. Let's take a closer look at that. Let's make sure that we don't have a sales tax obligation here. Again, there is some variation. I think Mississippi, if I remember, maybe Alabama might be $250,000. I think Texas might be $500,000. So they, like I said, they vary a little bit, but the 100,000 is the lowest threshold by which you would need to be worried about from a revenue perspective. Of course, there is the transaction count here to take into consideration. We are starting to see states repeal those transaction activities. And I think the thought process there is that with the original South Dakota versus Wayfair case, it was $100,000 or 200 transactions. What ends up happening is you might be in this scenario yourself, but there's a lot of businesses that might have 200 transactions, but maybe they're, $5 or $10. Maybe they're selling online, and these are very low dollar thresholds that all of a sudden, technically, someone with 200 $5 transactions has an obligation to collect and remit sales tax. If I do my math right, I think that's $1,000 in total revenue in the state. I don't think the states really ever intended to capture businesses that were selling $1,000, a month in revenue, or excuse me, $1,000 a year in revenue. So we've started to see certain states, South Dakota being one of the most recent, where they've kind of peeled back the transaction count and just landed on that $100,000 of revenue as their measure. And I think we're going to see more of that kind of trend in 2024. But again, we're at the end of 2023. Hopefully it's fairly simple to get a report out of your financial system that shows sales by state. If you've got anything where you have more than $100,000 and you're not already collecting or registered for sales tax purposes in those states, it's something you should take a look at. All right, so this is something else to consider here at the year end, and really looking at, were there any new products or new services that you launched in your business? And as we talked about Nexus and kind of the variation from state to state in terms of, what creates Nexus, what's the transaction count, what's the dollar amount, the taxability of certain products and services is extremely varied from state to state. I see a lot of companies assume that whatever the rules are in their home state kind of continues into other states. Generally speaking, most companies are very familiar with the sales tax in their home state, but then when they start to expand into additional states, they don't realize that, maybe something that was not taxable in their home state is taxable in another state, and now they've got some type of exposure there. So when you start to look at launching these new products and services, you really need to look at this on a state by state basis. And there's a couple of ways you can do this. First of all, if you're already using some type of sales tax software, like a Thomson Reuters or a Vertex, Avalara, TaxJar, the sales tax calculation systems that typically integrate with a accounting system, those types of solutions tend to manage the taxability very well from state to state. And the way they do that is each one of those systems have product codes or tax codes established within their system. So you'll see literally thousands and thousands of different product or tax codes within these systems. And behind the scenes, those companies are maintaining the taxability rules within each state so that they know that software as a service is exempt or non-taxable in California, but it is taxable in New York. So if you have one of these systems in place and you launch a new product or service, as long as you can get a direct one-to-one match of what you're selling to what's in their product or tax catalog, then the taxability is really solved for you. The problem is a couple of things. If you're launching a product that maybe there's a bundle wrapped together, so maybe you're selling a taxable item with a non-taxable item. So maybe you're selling, instead of some type of tangible personal property with separately stated installation, maybe you're selling an installed unit, and it's just one item that's inclusive of the unit as well as the installation. What tends to happen when you bundle items together is that if any piece of that bundle is taxable, then the entire bundle becomes taxable as well. And it gets difficult to map those types of bundles into a tax calc software unless you just map it to a kind of a general taxable category code. So that's something to kind of be aware of as you're doing this mapping, or excuse me, as you're trying to solve for the taxability from state to state. We do call it mapping when you map, your product code to their product code. But something else to think about, especially technology-oriented businesses, we see them launching new products, and quite frankly, it's really hard to figure out what in the heck is it. Is it a software as a service? Is it infrastructure as a service? Is it platform as a service? What is it? And sometimes the determination of the taxability is really more of a determination of what are we selling? And once we feel good that this is software as a service, then we can easily map it into a tax category within the software, or we can do the taxability research for that software as a service in the different states. Hopefully that makes sense, but those are kind of really the two different options there to consider. Another aspect that I think in a lot of scenarios does get overlooked is the collection, the approval, the management of exemption certificates. And if we take a little bit of step back, I think what's pretty fascinating about what's happened as a industry, you see it referenced here as the third bullet point, the Wayfair effect. Historically pre-Wayfair, what would happen is that a lot of vendors would sell to customers, sell to buyers. Those vendors may not have had a physical presence in the state where the buyer was. So the vendor pre-Wayfair had no requirement to collect the applicable sales tax. However, the buyer, when the vendor didn't charge the sales tax, had the obligation to accrue and report the use tax on those transactions. Now, quite frankly, very few, if any, consumers did this, and still very few do it prospectively. A lot of businesses, or maybe some businesses, did have a process set up to accrue use tax, not all of them. But the point being is that at least when the states audited businesses, it's tough for Department of Revenue to audit every consumer and find out that I didn't report, use tax on that shirt that I bought for $50 or whatever the case may be. It's just not worth their time or effort. But when the state audits a business, again, pre-Wayfair, there was a lot of effort focused on these use tax accruals. Let's look at the purchase activity. Was there sales tax charged? Did you report the use tax? And a lot of emphasis from an audit perspective were focused on those use tax audits and reviews. Fast forward, now we're post-Wayfair, and those same vendors that in the past didn't have the obligation to charge the sales tax, now they do. So the use tax has become less of an issue from an audit perspective. Still an issue, so I'm sure some of you have probably had use tax assessments under audit, but as a industry, those use tax audits are down because more and more vendors are responsible for charging the sales tax. That's kind of what the reference is here to the Wayfair effect. Now, as that is happening, the audits start to look more at these exempt sales. And does the seller have the proper exempt documentation in place? You see from a fairly recent report, the state of California received over $600 million in audit assessments for improperly documented exemption certificates. So it's a big deal to have these certificates to make sure that they're valid. They have a date on them, they're signed, there's a business listed, the business lists their tax ID number. There's certain criteria that you need to make sure you have for each one of these certificates. And in absence of a certificate, and this is part of the reason why we often refer to sales tax as it's form over substance. If you don't have the exemption form, the auditor is going to assume that transaction was taxable, and they're going to assess tax due plus penalties and interest. If they're doing some type of sampling, they can take that period and project that prospectively, or they might look at an entire audit period and look for every exemption certificate and match those up to exempt sales that you've reported. So it's a big deal to make sure that we're managing and tracking these exemption certificates appropriately. All right, so another thing to think about, again, moving into 2024, are you looking at any type of potential sale of the business or any investment from an outside capital perspective? When you start to look at these types of financial transactions, either an investment or someone purchasing the business, I can almost guarantee you there's going to be some level of due diligence specific to sales tax placed on your business. You go back probably 10, 15 years ago, this wasn't a huge issue in terms of the sales tax due diligence. It tended to focus more on income and payroll and overall quality of earnings. But now almost every transaction has some level of sales tax due diligence. And I can assure you that the buyer, the investor, they're not going to want to take risk, and they're going to be super conservative when they look at your business. And they're probably going to take a very conservative approach from a nexus perspective. They're probably going to assume that everything is taxable, and they're going to put this huge number out there in terms of exposure. It may be right, maybe it is, maybe it's not. It's up to you at that point to kind of dig into that and understand, for example, yes, we had Nexus, and yes, we had $1 million in revenue over, this 4-year history. But if you start looking at that $1 million of revenue, here's what was taxable, here's what was not taxable, and you can kind of start to peel away and chip away at what that overall sales tax risk and exposure might be. The issue that I see is that when you're trying to do that while you're selling the company, it's just not a good scenario. It could make the buyer a little bit jittery. Did this company not have their sales tax in order? What else is not in order in their business? Do we need to look a little bit more closely in other parts of the business? But if you've got the sales tax in order, it presents, a good picture to that potential buyer. So we definitely encourage people to, look at sales tax, look at the potential exposure and risk. If you're looking at one of these future events, well, certainly really at any time, but especially if you're looking at some type of future event, you really need to get on top of this. So, what are the options if you do see that you have some level of sales tax risk in the business? We've listed 2, there's really a third. I'll kind of go through each of them here, but the first one is that voluntary disclosure agreement, and I'll refer to it as a VDA. But this is a methodology by which really every state has some type of prescribed format. They may not call it a VDA. Some states call it a managed audit, but it's some type of ability for a company, a taxpayer that has been delinquent and not been collecting and remitting sales tax as they should have. It's an opportunity for that taxpayer to come forward. And generally, in exchange for the voluntary coming forth to that state, the state's going to waive the penalty that they would normally assess, and the state would limit the look back period of this disclosure period or of this managed audit. And from a look back period, what I'm describing is that most states are usually either 36 or 48 months. Now, if you're a business that's been in business and has had taxable transactions for 10 years, doing a VDA could be very advantageous. If you have a large tax exposure over that 10-year period, you can voluntarily come forth, report the 36 months, the 48 months, whatever the time frame may be, report the tax due in that time period, and the state will waive everything prior to that. So I've seen scenarios where companies have significant exposure in year 5, year 6, and very minimal exposure in years 1, 2, and 3. And it's a huge financial, I don't want to say a windfall, but it's a big benefit to chop off those older periods and then only report the tax due in the most recent periods. So that's essentially what the VDA is. Another option, when you discover that you do have some type of sales tax risk or exposure in those prior periods, is that you could choose to register with a historic effective date on the sales tax registration. And what I mean by that is, maybe you discovered that as of June 1st of 2023, maybe that's when you hired a remote employee, and that's when you should have started collecting sales tax and you didn't. You can go to the state and in your sales tax registration, you can put June 1st, 2023 as your start date or your effective date for sales tax purposes. Now, what's going to happen immediately at that point is that the state's going to issue notices with various penalties. They might assume some level of tax liability and also assess some level of interest. But you're going to be responsible now for filing those back returns, reporting the tax due, paying the interest. And in many scenarios, you're still voluntarily coming forward. In this scenario, in many scenarios, you would have pretty good success in getting that penalty waived as well. Again, just from a voluntary compliance perspective, states might be willing to work with you. Now, the third option, and what's not listed here, is utilizing a current period effective date. So let's take that same example where we did have exposure back to June of 2023. Maybe it goes back a little bit further, but for whatever reason, either I have very immaterial sales to report during that period, or if I don't, or excuse me, if I do try to report all of this back tax, there's no way I can sustain my business. It's just such a massive exposure that I can't do anything about it. I'll never be able to pay it, but I want to be a good corporate citizen and I want to start collecting and filing prospectively. Those tend to be the two scenarios where we see people take for example, right now, June 1st, 2024, let's start doing the right thing prospectively. There's some risk associated with that when you take that approach, because you're not being entirely truthful and not disclosing the full history of the business. But overall, as a philosophy, I know I have, and you've probably heard one of my partners, Jeff Meggs, talk about this before as well. The states want voluntary compliance. And if we can help companies get into compliance, that's really what the states are looking at. And there are those real life scenarios where a company looks at this exposure and it's a $10 million business and they've got $5 million of exposure. And there's no way they'll ever pay it all. But they want to at least start doing the right thing prospectively. Again, it's not without risk. If you do get audited, there's a potential that they audit those prior periods and you'd have to pay that tax at that point. So there are options here, when you find this historic risk and exposure in the business.
Brian, we did have a question come in,
okay.
And this goes back to the topic of increased sales into new areas. We were wondering if there's a responsibility to collect sales tax on international sales.
Yeah, good question. And I think what's probably being described there is, I can see it one of two ways. I can see an international business selling into the U.S. In that scenario, yes, if you've met any of the Nexus requirements, whether it's a physical presence or whether it's an economic presence, that foreign-based business would have an obligation to collect the applicable sales tax. Again, if they have Nexus and if they have taxable sales. In the exporting example, where we're a US-based business and we're selling overseas, there will be some level of tax due. I wouldn't see it as a sales tax requirement. There's a potential based on the country that you're selling into that there could be some type of VAT requirement if you're selling directly into that country. There are other scenarios where maybe you're selling to an exporter of sorts, whereas I'm getting a little bit ahead of my skis on this one, but I believe when you're selling to, I'm calling it an exporter, that could be considered like a reseller, which of course would be exempt for resale purposes if you get that resale exemption certificate. But there are certain businesses that you can sell to that are exempt, that will take the goods out of the country, pay the duties in the foreign business, and they'd be responsible for any of the foreign VAT. So essentially, I would say if you're selling internationally, you're probably not going to have a US sales tax obligation, but there's a potential that you're going to have a VAT obligation in that country that you're selling into, especially if you're selling direct into that state or into that country. Hopefully that answered the question, and if not, feel free to follow up with us afterwards. And it did raise another thought that I had that I meant to address earlier as we were talking about Nexus, we reference this physical presence and this economic presence. Those are mutually exclusive of each other. And what I mean by that is I often have the conversation where someone says, hey, I've got an employee over here, but I'm under the revenue threshold, so I guess I'm good, right? Well, no, it's really either of those standards are met. If you've met the physical presence standard, you have sales tax nexus. Separately, if you've met the economic nexus standard, you have a sales tax. You have sales tax nexus and a sales tax obligation there. So they are kind of mutually exclusive scenarios. This next topic, and I think it's the last one that we actually had, in terms of the presentation, and then we can take some questions as well. But did you acquire any businesses or a business during the course of the year? Hopefully, if you did, similar to the previous slide where we were talking about if you're looking to sell your business, there's going to be some level of due diligence placed on the business, and typically you want to get out ahead of those sales tax issues before they become an issue when you sell the business. This is kind of the flip side of it in terms of if you're buying a business, hopefully you've done some level of due diligence from a sales tax perspective. Maybe you've negotiated some type of escrow or some type of reduced purchase price where you've assumed the liability for sales tax purposes. But hopefully you've at least addressed that sales tax to some extent. And we do see those similar mitigation options from a acquisition perspective, but now oftentimes the acquiring company is forcing the hand of the buyer to do the VDA, and in a lot of scenarios they're not as lenient with taking some level of risk, and they're going to force VDAs in every scenario. If you're that buyer, that's a great position to be in if you can, is to assume minimal, if any, sales tax risk in the business. Let the seller deal with that, force the VDA or escrow some amount over a period of time. Other factors that you would have to consider is, how is this acquired business rolling into or being integrated into the business? There's a integration of systems, of course, but there's potentially the integration of the legal entity structure. So depending on the nature of the acquisition, you could acquire the entire entity, the entire business, and now you have, two separate legal entities that have their own sales tax obligations that you're responsible for. Or it could be something that, maybe you acquire just the customers, or maybe you roll that business or integrate it into the legal entity structure of the current business, which could change, of course, your sales tax nexus footprint and where you need to register. In that event, if the company that you're acquiring had existing sales tax accounts and you're now merging the businesses together into one legal entity, you got to make sure that you close out those sales tax accounts, assuming that, again, you acquired the business as a whole and you acquired those sales tax accounts. You're going to want to close those and shut those down. There certainly are acquisition scenarios where, again, for example, maybe you acquire the customers and the legal entity and the tax obligations, the sales tax registrations continue to sit with the prior business, and then they need to close out those registrations and take care of that piece of the business. So I think that was everything that we had just in terms of those kind of quick topics of, some things that you need to take a look at, think about in your business. Definitely a good time of the year to, resolve any of those aspects and have a clean slate kind of going into next year. So I think Kate was able to pull up the poll here for us. Just let us know if you'd like for us to follow up with you at all. Maybe you're good to go. Maybe you've got some specific questions that you want us to talk about. let us know. So
We
I'm going to
did
try.
have another question come in here, Ryan.
Okay, perfect.
Wanted to get to that really quickly here. Martha asked, as an Ohio company, am I responsible for Ohio vendors to charge sales tax on invoices? I get invoices from Ohio vendors and some charge sales tax and some don't.
Yeah, that's a great question. And there are some subtleties from state to state, but I would say the Ohio vendor selling to you in Ohio, they should be collecting the applicable sales tax. Now, where it becomes a potential variation from state to state is depending on the state, they could hold you as the buyer responsible for the use tax and or hold the seller responsible for not charging the applicable sales tax. So if one or the other gets audited, there could be an issue for one or the other of you. But I would say that Ohio vendor should be charging you the applicable Ohio sales tax. If they don't, and they will not charge that, maybe you have the conversation with them and ask them to charge that prospectively. If they won't do that, you should be accruing the use tax due and reporting that to the state of Ohio. All right, I see another question here by Steve.
I think that's all we had here. Oh, yes.
Yeah, I'll take this one from Steve here. Let's see. Any chance states will make the process more uniform? The Fair Marketplace Act. It was okay. Yeah. So, Steve, this is another interesting topic, just from the perspective that I remember when I got into this industry, and this was like back in 2000, 1999, 2000, somewhere in that time frame. And I was working, I had interviewed with a different sales tax company, and I kind of asked that question, like, well, what kind of risk is there to the business? Because they were a sales tax outsourcing company similar to Tax Connect. What's a big risk to the business? And there was the idea of streamline, uniformity, simplification. It's been around for at least those 24 years, and it's been around for, I think, 15 to 20 years before that. So this is a topic that's been around for, I would say 30, 40 years in terms of simplification. And quite frankly, it seems to me like every time the states do something, it makes it more complicated. Case in point, the economic nexus. Hey, this was supposed to give us a kind of a bright line test. Hey, do I have nexus? Do I have revenue? Do I have the transactions? Yes or no? It's very, very black or white in that scenario. However, physical presence never went away. So all it did was add a layer of complexity to something that was already complex. You see now states implementing and having legislation for retail delivery fees. So now all of a sudden it's not a sales tax, but now I've got a retail delivery fee that I got to figure out and manage, and maybe file a separate return for that and figure out how to calculate that on all my orders. So I'm familiar with what you've described in the Fair Market Act or Fair Marketplace Act, whatever it was called. But my personal opinion is I don't think it's going to get any more easy. I think even if we go to some type of national sales tax, it's not going to cut out the states. It's just going to add now a national or a federal sales tax that we have to report. So I do know that there are, of course, the streamline sales tax project, where there is some level of uniformity amongst I think the 23 participant states there. But the more complicated states, quite frankly, and the larger states aren't members. So when you look at the more complicated states and the more aggressive states like California, Florida, New York, Illinois, Texas, none of those are SST states, and I just don't see them wanting to join. I think they I think the individual states and even the local jurisdictions like to have control, and they like to be able to kind of, cater to their constituency. I don't know this for a fact, but if I look at California, I mentioned them earlier that, they don't tax software as a service. I bet you there was some type of lobbying effort associated with, hey, we've got all these tech companies in California. Let's make sure that we're not making them collect sales tax. And I think that happens very frequently, is that politicians, work with their constituency to have certain items taxed or exempted. And I just don't see that going away. My personal opinion, at least. I'm kind of scanning through the questions here as we're wrapping up to see if we had anything else. I see one here from Carolina that we may have to take offline. Selling products as a bundle, if we didn't itemize the extended maintenance support in a product in our sales invoice when we were selling to our customers, is this considered as a product and taxable for both? Yeah, again, without getting into the details, what happens with these bundles, and again, I'm going to say generally speaking, if you have a taxable and a non-taxable component, the taxable aspect of that, if you don't itemize them, you don't invoice, separate, I shouldn't say invoice separately, but you don't have separate line items, the taxable item is going to taint the non-taxable item. Now, there are some specific rules from state to state where, for example, it might say if less than 10% of the bundle is non-taxable, then, or maybe, let me rephrase that. If less than 10% of the bundle is taxable and more than 90% is non-taxable, then the entire transaction, you can treat it as non-taxable. But generally what happens in these bundled transactions is it's generally a taxable product with some type of non-taxable service or installation that's a more minor component of the overall bundle, and then the entire transaction is subject to sales tax collection in that scenario. Now, there may be very specific business reasons for wanting to sell bundles, and I get that. I guess the telecom or the cable companies are into the triple play, which is, what is that, cable, internet, and TV all bundled together. So there's business reasons and marketing reasons why you want a bundle, but you just need to be aware that there are tax consequences of doing that. So happy to talk to you in more detail about that if you'd like. All right, I think, Kate, that was all the questions that I had. We can go ahead and wrap up here and give everybody 12 minutes of their day back. So thank you so much for joining today, and hopefully came away with at least one or two gems here and something that you could look at in your business, and perhaps make sure that you're, if you're not already handling sales tax amazingly, hopefully it gives you an opportunity to correct that prospectively. So thanks again, and we'll talk to you soon.